$2.1 trillion? That's not a typo, that's not a projection, that's not a future estimate. That is the amount of capital BlackRock has quietly shifted out of US dollar-centric exposure over a very short window of time. And here's the unsettling part. It didn't happen during a crash. It didn't happen during panic. It didn't happen when markets were falling. It happened while headlines were telling you everything was fine. So the real question isn't whether BlackRock moved the money. That's already documented. The real question is, why would the largest asset manager on earth start repositioning trillions before the crowd even realizes something is changing? And more importantly, should you be worried? Because when institutions this large move, they're not guessing, they're not reacting, they're positioning ahead of something. And by the end of this video, you'll understand exactly what that something might be. Not speculation, not fear, patterns. The same patterns that quietly preceded every major financial shift of the last century. Let's start with something most people misunderstand. BlackRock doesn't trade, it doesn't speculate, it doesn't chase headlines. BlackRock manages money for pension funds, sovereign wealth funds, insurance companies, endowments, and governments. Money that cannot afford to be wrong. Their job is not to predict tomorrow. Their job is to survive the next 20 years. So when BlackRock changes allocation at scale, it's never emotional, it's structural, which makes this moment very different from what you see on financial news. Because while retail investors debate whether the next Fed meeting is bullish or bearish, BlackRock has been quietly rebalancing exposure away from US assets and toward international infrastructure, commodities, private credit, and real assets. Not exiting America entirely, but reducing concentration, and concentration is the key word here. Because historically, financial damage doesn't come from owning the wrong assets. It comes from owning too much of what used to work. Now, before we go any further, let's address the obvious pushback. BlackRock didn't literally wire $2.1 trillion out of America overnight. True. What they did was more subtle, more sophisticated, and more important. They changed portfolio weightings, reduced forward exposure, rotated capital into non-U, S markets, real assets, and private structures that don't depend on the same assumptions that US markets depend on. In plain English, they started preparing for a world where the last 30 years done to repeat the next 30. And that alone should make you pause. Because for most of your investing lifetime, the rule was simple. Buy US stocks, buy US bonds, trust the dollar, let time do the rest. That formula worked exceptionally well. But history has a habit of punishing people who assume permanence, especially when systems grow large, indebted, and politically constrained. Let me ask you something. When was the last time the dominant financial system voluntarily stayed dominant forever? It's never happened. Not because anyone wanted it to fail, but because scale creates fragility, and fragility reveals itself quietly, long before it becomes obvious. Now let's talk about why this moment feels different. Not dramatic, different. Over the last decade, the United States benefited from three enormous tailwinds: ultra-low interest rates, global demand for dollars, and asset inflation driven by liquidity, not productivity. Those tailwinds masked a lot of structural issues: rising debt, falling labor participation, a shrinking manufacturing base, political gridlock. As long as money was cheap, none of that mattered. But money is no longer cheap, and that single change rewrites the math of everything. Here's the part most people miss. When interest rates rise, debt doesn't just become more expensive, it becomes more fragile. Because every dollar of debt assumes future growth will outpace future costs. And when that assumption breaks, systems don't collapse all at once. They rebalance, then strain, then crack in places most people aren't watching. BlackRock is watching those places. Which brings us to the heart of the issue. Why would BlackRock reduce US exposure now, when markets are near all-time highs? Because institutions don't wait for crashes. They wait for inflection points. Moments where the risk-reward equation quietly flips. Where upside becomes incremental, but downside becomes nonlinear. And those moments almost never come with sirens. They come with subtle signals, like sustained deficits during economic expansions, like rising interest costs crowding out productive investment, like capital flowing into financial assets instead of real output, like central banks trapped between inflation and debt service. None of these trigger panic, but together, they change long-term strategy. Here's an analogy that makes this clearer. Imagine a bridge. For years, it carries more and more traffic. Heavier vehicles, more weight. From the outside, everything looks fine. No cracks, no alarms. But engineers don't wait for collapse. They monitor stress points. And when weight approaches tolerance, they redirect traffic, quietly, gradually. Because once a bridge fails, it's too late. BlackRock is redirecting traffic. And that doesn't mean America is collapsing. It means the margin for error is shrinking. Now let's talk about where that money is going. Because this is where the story gets interesting. BlackRock hasn't been moving into cash. They've been moving into things. Infrastructure, energy transition assets, commodities, private credit. Emerging market debt with hard asset backing, in other words, assets tied to physical reality, assets that exist outside pure financial engineering. Why does that matter? Because financial assets depend on confidence, real assets depend on utility, and when uncertainty rises, institutions always favor utility. This is not new. In the 1970s, capital moved into hard assets as inflation eroded paper value. In the early 2000s, capital moved into emerging markets as US growth slowed. After 2008, capital moved into tech as liquidity exploded. Every era has a dominant trade. The mistake investors make is assuming the last era never ends. BlackRock doesn't make that mistake. Now let's address the elephant in the room. Is this about the dollar? Partially, but not in the way social media wants you to believe. This is not about the dollar collapsing, it's about the dollar becoming less dominant. And dominance is binary in headlines, but gradual in reality. The dollar doesn't need to disappear to change behavior. It just needs alternatives to become good enough. And that's exactly what's happening. Not because the US is weak, but because the world is fragmenting. More regional trade, more bilateral agreements, more localized supply chains, more political hedging. Every one of those reduces the need for a single central financial artery, which again, doesn't cause collapse. It causes redistribution. And redistribution always creates winners and losers. The question is which side you're on. Now here's where things get uncomfortable for individual investors. Most people's portfolios are built on a single assumption, that US assets will continue to outperform simply because they always have. But always usually means during a very specific historical window, the post-World War II era. The globalization boom, the tech revolution, the zero-rate environment, those conditions were extraordinary. They are not permanent. BlackRock's repositioning suggests they don't expect a repeat. They expect something messier, slower growth, higher volatility, more inflation sensitivity, more geopolitical friction. In that environment, concentration is risk. Diversification becomes survival. Now before you panic, let's get something straight. BlackRock is not betting against America. They're betting beyond America. And there's a massive difference. They still hold trillions in US assets. But they're no longer assuming America alone will carry global growth. That assumption powered portfolios for decades. Its expiration doesn't make headlines. But it changes everything. Think about your own financial life, your retirement account, your index funds, your home equity, your savings. How much of it depends on US markets continuing to behave exactly as they have? How much of it depends on low inflation, stable rates, and rising asset prices? And what happens if those conditions don't disappear, but simply weaken? This is where most people get blindsided. Because financial pain doesn't require catastrophe. It just requires expectations to be wrong. If markets return 3 to 4% instead of 8 to 10%, if inflation averages higher than wages, if volatility becomes normal instead of rare, that's enough to quietly erode wealth, especially for people who thought they were playing it safe. BlackRock understands this, which is why their shift matters more than any headline. Because institutions don't move on fear, they move on math, and the math is changing. Here's the part almost no one talks about. America's biggest risk isn't collapse, it's complacency. The belief that dominance equals immunity. But history shows the opposite. Dominance creates blind spots, and blind spots are expensive. Empires don't fall because people panic too early. They fall because people assume stability too long. And that's why BlackRock's actions deserve attention, not because they signal disaster, but because they signal adaptation. And adaptation always happens before the narrative changes. In a moment, we're going to talk about what this means for you, not in theory, in practical terms. What kinds of assets tend to benefit during periods like this? What tends to underperform? And how individuals can think like institutions without needing billions. But before we do that, there's one more critical piece you need to understand. Because if you miss this, everything else sounds like noise. And it has nothing to do with markets. It has to do with psychology. The biggest financial shifts don't feel dramatic when they begin. They feel boring. They feel technical. They feel like portfolio rebalancing. Until one day, people realize the rules changed years ago. And by then, positioning is already locked in. BlackRock is already positioned. The question is whether you're paying attention. Because what comes next isn't about fear. It's about alignment. And that's where this story really starts to matter. What BlackRock is doing right now isn't dramatic. And that's exactly why it matters. Because the most dangerous moments in finance aren't when everyone is panicking. They're when everything still looks calm. But the incentives underneath have already changed. To understand what comes next, you have to stop thinking like a trader and start thinking like a system. Systems don't break suddenly, they reprice. And repricing doesn't announce itself. It shows up quietly in returns that disappoint, in portfolios that feel heavier, in goals that suddenly move further away, even though you did everything right. That's the real risk most people face over the next decade. Not collapse, but erosion, slow, persistent, psychologically exhausting. This is where most investors lose, not because they panic, but because they stay loyal to assumptions that no longer hold. So let ES talk about what actually tends to happen when the world moves from a single dominant growth engine to a more fragmented one, because history gives us clues, not predictions, clues. In periods like this, broad market averages usually underperform expectations. Not crash, underperform. Volatility rises, but not evenly. Some years feel fine, others feel brutal. Returns become lumpy, and asset selection starts to matter again. That's uncomfortable for a generation raised on index investing, but it's reality. For decades, you could buy the S&P 500, ignore everything else, and win. That worked because globalization, falling rates, and expanding leverage lifted almost all boats. But when those forces slow or reverse, correlations change. Suddenly, diversification actually matters. This is why institutions are rotating toward assets with different drivers. Not because they know exactly what will happen, but because they know what won't. They don't expect a straight line up. They don't expect policy to remain predictable. They don't expect debt to magically shrink. So they build portfolios that can survive multiple outcomes. That's the mindset shift most individuals haven't made yet. Let's talk about what tends to benefit in these environments. Historically, assets tied to real-world utility outperform purely financial constructs when inflation is sticky and growth is uneven. Infrastructure that people rely on regardless of cycles. Energy systems that don't disappear when sentiment changes. Resources that can't be printed or diluted. This doesn't mean everything else becomes worthless. It means leadership rotates. And rotation is where opportunity and danger live. Now here's where people get confused. They hear real assets and think it means abandoning technology, innovation, or equities altogether. That's not what institutions are doing. They're being selective. They're separating growth from speculation. They're asking a different question than retail investors. Not what can grow fastest, but what can still function if assumptions break. That's a very different filter. It's the difference between betting on narratives and investing in resilience. And resilience isn't exciting. It doesn't trend on social media, but it compounds quietly. Another area institutions are focusing on is private credit. Why? Because when traditional lending tightens, borrowers don't disappear. They just pay more. Private credit fills that gap. It's less liquid, less visible, but often better aligned with inflationary environments. Again, not glamorous, just logical. And this is where the average investor feels locked out, because you don't have access to private deals or infrastructure funds. But here's the truth most people don't realize. You don't need access to everything institutions buy. You need alignment with the direction they're moving. The biggest mistake individuals make is trying to copy exact trades instead of copying frameworks. BlackRock isn't saying, sell America. They're saying, don't bet your future on one system behaving perfectly forever. That's a lesson individuals can apply without trillions. It starts with asking uncomfortable questions. How exposed am I to a single country, a single currency, a single economic outcome? How much of my wealth depends on asset inflation versus real cash flow? How sensitive am I to inflation lasting longer than expected? These aren't questions most people like asking, because the answers often force change, and change feels risky, even when staying still is riskier. There's another layer to this story that doesn't get enough attention. Politics, not partisan politics, structural politics. The US political system is increasingly constrained. High debt limits, policy flexibility, polarization slows decision-making, demographics strain entitlement systems. None of this causes immediate crisis, but it reduces options. And markets don't like reduced options. They price that in quietly. Institutions understand this dynamic well. They don't need chaos to adjust. They just need probabilities to shift. Now let's address a common reaction. Okay, but what am I supposed to do with this information? The answer is not panic, and it's definitely not copying extreme strategies you see online. The goal is not to outsmart institutions. It's to stop unknowingly betting against them. That starts with understanding your own exposure. If your retirement, savings, and future plans are all dependent on US equity multiples expanding forever, that's a concentrated bet, whether you intended it or not. If your emergency reserves lose purchasing power every year but you have no inflation hedge, that's a silent tax. If all your assets perform well only in a low-rate, low-inflation environment, that's fragility. You don't fix fragility with complexity. You fix it with balance. That might mean holding assets that feel boring, or underperform during bull markets, or don't impress anyone at dinner parties. But boring assets tend to matter most when conditions change. Now, let's talk about timing, because this is where people get paralyzed. They want to know when. When will the shift happen? When will markets react? When will it be obvious? Here's the uncomfortable truth. By the time it's obvious, positioning is already late. Major transitions don't ring bells. They whisper. They show up in returns that don't match expectations, and portfolios that feel heavier year after year. and narratives that slowly lose credibility. BlackRock isn't trying to time a crash. They're positioning for a decade that looks different from the last one. That's the mindset individuals should consider adopting. Not fear-driven, but forward-looking. Now here's a counterintuitive insight most people miss. Periods like this actually create opportunity, but only for those who aren't over-leveraged and overconfident. When volatility rises and correlations break, disciplined investors gain optionality. They can rebalance, they can buy selectively, they can adapt. People who are stretched can't. They're forced to react. That's why reducing unnecessary debt matters. Not because debt is evil, but because flexibility is priceless when conditions shift. Liquidity gives you options, and options are power. Now let's talk about mindset. Because information alone doesn't protect anyone. Interpretation does. There are two dangerous extremes right now. One group believes nothing has changed and never will. The other believes collapse is imminent and unavoidable. Both are wrong. The world isn't ending, but it is reorganizing, and reorganization creates friction. Winners and losers. Relative gains and losses. The people who navigate these periods best aren't the loudest or the boldest. They're the most adaptive. They watch incentives. They follow capital flows. They stay curious instead of dogmatic. That's why watching what institutions do, quietly, is more valuable than listening to what anyone says loudly. BlackRock's actions don't mean disaster. They mean preparation, and preparation is never a bad signal. Now let me ask you something personal. If nothing catastrophic happens, if markets don't crash, if life continues normally, but your investments underperform for 10 years, would you still feel secure? That's the scenario most people aren't preparing for, because it doesn't feel dramatic. It just feels disappointing. And disappointment compounds faster than people realize. This is why paying attention now matters. Not because something terrible is guaranteed, but because alignment today prevents regret tomorrow. Before we wrap up, there's one final idea that ties this entire story together. Capital is not emotional. It doesn't care about narratives, patriotism, or comfort. It flows toward favorable risk-adjusted outcomes. When those outcomes change, capital moves, quietly, relentlessly. BlackRock is simply doing what capital always does, adapting. The question is whether individuals remain static while the system evolves, or whether they evolve too. That doesn't mean abandoning everything you believe. It means updating beliefs when evidence changes. That's not weakness, that's intelligence. If this video made you think differently about how institutions see the world, that's a good sign. If it challenged assumptions you didn't even realize you had, even better. And if you're curious about how these shifts affect specific asset classes, currencies, or long-term strategies, there's more to explore. If you want more insights like this, make sure to subscribe and hit the notification bell. Pay attention to the patterns. Watch what capital does, not what headlines say. And remember, by the time everyone agrees something has changed, the advantage is already gone. If you found value here, stay curious. There's a lot happening beneath the surface right now. And the people who understand it early tend to sleep better later.